Over the past few weeks, Bitcoin has slid sharply from its late 2025 peaks, dipping through major psychological levels and even briefly touching multi-month lows around $60,000 to $70,000 before a partial rebound. This drawdown has erased significant gains from the prior rally and spiked volatility across crypto markets. What's causing the bearish move? 1. Macro and risk-off environment. Bitcoin is behaving like a risk asset, moving in step with broader risk sentiment. Strong inflation data and uncertainty around Federal Reserve rate cuts have kept liquidity tight and diminished risk appetite. That reduces speculative money flowing into crypto and increases selling pressure when markets sour. 2. Institutional selling and ETF outflows. In contrast to the heavy institutional inflows that fueled Bitcoin's last rally, Bitcoin-linked ETFs have seen meaningful outflows, removing a key source of sustained demand. As big players reduce exposure, liquidity dries up and prices weaken. 3. Technical breakdown and liquidations. Once critical support levels were breached, algorithmic selling and forced liquidations, especially in futures and leveraged products, accelerated the decline. Over $2 to $3 billion in leveraged positions have been wiped out in surge events. 4. Sentiment shift in risk aversion, profit-taking after last year's massive rally, rising volatility, and correlation with tech equity weakness all fed into a broader risk-off mood. When risk assets falter, Bitcoin often leads the sell-off. 5. Psychological and structural factors. Historically, Bitcoin corrections occur after big runs, and the bearish wave we're seeing fits broader cycle patterns where markets cool after extended speculative gains. Near-term technical and sentiment signals. Bearish signals. Lower liquidity and thin order books make falls sharper. Continued ETF outflow signal sustain selling pressure. Key support zones may break if macro sentiment worsens further. Bullish counterpoints. Some on-chain indicators show leverage flushed and much of the supply now underwater, a condition that can precede bottoms once sellers are exhausted. Short-term rebounds happen when risk assets stabilize. Because Bitcoin remains tightly coupled to global asset sentiment and liquidity conditions, sharp rebounds or renewed weakness can both happen quickly, depending on macro triggers. What to expect next? Base case, neutral. Bitcoin could trade sideways or retest recent lows while markets digest macro data. Expect choppy ranges and volatility until a clear catalyst emerges. Bearish scenario. If institutions continue reducing crypto exposure and risk aversion deepens, the market could extend the correction toward lower support bands. Bullish turn A shift toward accommodative monetary policy, stabilization in risk assets, or renewed institutional inflows could reignite demand and set up a counter-trend rally. In short, the recent Bitcoin sell-off isn't a single event, but a confluence. Macro rate expectations, institutional outflows, technical breakdowns, liquidations, and broader risk-off sentiment converge to create a self-reinforcing downturn. Whether this marks the bottom or a deeper correction continues to depend on macro liquidity and investor appetite.